Life comes in waves, and ride them or drown. So let's go for a ride. So how do I finesse the markets? First things first, when I say the markets, I mean the foreign exchange markets. Now, if you don't know what this is, I'd advise you go and have a Google and at least come to terms with the basic terms when discussing this topic. And if there's any words I use that you're unsure of, I'd advise that you jump on a website called Baby Pips and have a read, because I'm trying to jump straight into the nitty gritty. But drop a comment if you'd like me to cover the basics, and we can look at covering that in another video. So, to understand how to finesse the markets, you're going to have to understand a few other things first. So I'm going to start by talking about liquidity. Everything is either a buy or a sell. So when you're in a sell position and you take profit, you're buying the lots that you sold when you first opened the trade. And when you're in a buy position and you take profit, you're selling the lots that you bought, just at a change in price. So you have to do the opposite action which you open the trade with to get out of the trade. So the next thing to understand is money is neither created nor destroyed in the markets. It only gets transferred. So when you take profit, you're taking someone else's money. And when your stop loss gets hit, someone else is taking your money. So here you can see a bearish market, and you can see a load of sell orders have been placed around this area. If these people had any sense about them, they will have their stop losses slightly above this area. So if price was to push up above these areas, you would see all these sell orders get wiped out and stop losses get hit. And as we mentioned earlier, money is neither created nor destroyed in the markets. So one person's loss is another person's gain. So these areas we would identify as high liquidity areas. Why is this important? Because once you learn to identify high liquidity areas, you can use this to your advantage, just as the banks do. So what you often see happen is what I like to call a liquidity grab. A liquidity grab is when liquidity is being created, as we discussed. The price is then driven into the liquidity by the institutions, a concept I'll be describing in another video, hitting all of these stop losses in these areas and taking out all of these buy or sellers, and then the price then rides down into the direction it was going to go in the first place. So in the back of your head, when you see these structures, you should always be thinking that the price will drive there, grab the liquidity, then make its move. So this doesn't always have to be a flat horizontal line like in some of these examples. Rising wedges, falling wedges, double tops, double bottoms are all examples of liquidity buildup. So further examples of where liquidity lies in the market are places where the price has moved very quickly. I'm going to explain to you why. So I mentioned briefly about the institutions, and I'll be covering institutional candles further in another video, but just as a brief description, you can think about things like hedge funds and banks when I talk about the institutions. And yes, they do all trade on the foreign exchange markets. But as you can imagine, they trade with much, much larger amounts than us retail traders do. Much larger amounts. And as I mentioned, money is neither created nor destroyed. So for them to close their orders, they need to be able to get the money that their orders are worth. So I'm talking about lot sizes to the millions. So what they often do is they hedge bets against themselves. So hedging is when you open two opposite trades, both a buy and a sell at the same time. So next time you're on your MetaTrader 4 or whatever app you guys use, try open a buy and sell. When the price goes up, your buy will be in profit. If the price was to go down, your sell would be in profit. But as you can imagine, the markets go both up and down. It's not just about where you enter, it's also about timing. So what they'll do is they'll wait for the price to drop and then close their sell. If they're looking for a sell, they'll close their sell in a profit, and then they'll wait for the price to come back up and be able to close their buy at break even. So areas like here, you might identify some liquidity, and I will be looking at this candle pushing the price in the opposite direction before the liquidity was created. I would then identify this candle and expect the price to fill the liquidity before making its move. So I hope that's a brief explanation of what about liquidity, guys. Any questions, let me know in the comments. If you guys have enjoyed this and gained any value from this, then please drop a like and a subscribe, as it helps the channel grow and it helps me to provide you guys with more value. And if you guys enjoyed this type of video, also let me know in the comments and drop some waves down below. Alright, ride the wave out. Love.